Hi. Yes, we are back. So far, we have revised admission of partnership, retirement of partnership, death of partnership, also dissolution of partnership. Now we are entering into the new concept, that is amalgamation of partnership firms. That is, amalgamation means nothing, bringing two or more firms together, more firms together and forming it as one, or joining one firm with the other existing firm. All these things comes under the amalgamation. Okay. See, we know that two person will come together to form the partnership. At least two person, right? They will come together and they will form a partnership business. Also, partnership, that is not the only method in which you can form the partnership. It can be done in this way also. How, sir? One, when two or more sole proprietor forms a new partnership firm. Let us assume there are two people, A and B. They are into the same business. Let us assume clothing business. Okay, A is also into the clothing business, B is into the clothing business. For example, A is into men's clothing, B is into women's clothing. Of course, B should be having a lot of profit, but still, let us assume Reliance Trends entered into the market. In that area, Reliance Trends or Max has entered into the business. Now people who want clothes for their kids, who want clothes for the female, who want clothes for the men, everyone started visiting there because it is a one place solution. So A and B, who were not even a competitors because the segment was different, what they did was, to tackle this competition of the Reliance Trend, they came together and they started a new business. I mean, they formed a partnership where A will bring the resources of the men's clothing, whereas B will bring the resources of the women's clothing. So this kind of partnership also could be formed. That is, where people were sole proprietors before and they come together and they form a new partnership firm. There is one existing partnership, it absorbs the sole proprietor, usually due to the competition. Let us assume I am into some business. Let us assume water bottle business. I am in the water bottle business. There is one more competitor for me, which is a firm, partnership firm. Now they came to know that I am the biggest competitor for them. So they acquired me. I mean, they purchased me. They took me to their partnership firm. They told, boss, you stop this sole proprietor, you join us, we three will build this business a very big. Okay. Next one is, when one existing partnership firm absorbs the other partnership firm. That is, there is one partnership firm. Let us assume A and B are doing. There is one more partnership firm, C and D are doing. Both are into same business might be. So now C and D are having more money than A and B. So they came to know that A and B are a competitor. A and B firm is there, no, that is direct competitor to C and D business. So what they did is, they purchased the business of A and B and they made A and B as their partners in the new firm. That could also be done. Next one is, now let us assume AB, they started a partnership business, no, clothing business. In the same way, CD also started. CD were in a kids business, kids wear. CD were in kids wear. Now, when the Reliance Trends came, when the Max came, Pantaloons came, what they did was, they did men, women, kids, three. Now, to tackle this competition of even kids, what they did was, AB came, CD came, they formed a new partnership firm. That is, where two existing partnerships comes together to form a new partnership firm. Okay, in that we are going to discuss first about when two or more sole proprietors forms a new partnership firm. That is, where two or more sole proprietors, I told no, A and B. Example, menswear, women's wear. So they form a new business. How the accounting is going to take place? Simple. You have to close the business of A. You want to close the business of B. Bring the resource into the new partnership firm, AB and Co. I repeat, close the business of A, close the business of B, bring the resource into the new business, that is AB and Co. That's it. Okay. How to close? Simple, bring all the assets into the realization account. A's asset, bring all the asset into realization, liability to realization. Later, the firm will take over it. The firm will take over those assets and liabilities. Sir, whether we should bring a cash and bank also? If the question says the firm takes over the whole business, then your cash and bank is also included. If the question is silent about it, then excluding except that cash and bank, everything is taken over by the firm. They will give what are the things taken over by the firm. Now the question comes. Okay sir, they take over, that's fine. Firm will take over, no? So firm will take over and give the same proportion of capital to these people. For example, A's asset is 10 lakh rupees. A's liability is 4 lakh rupees. Now 6 lakh rupees, firm is going to give him as a capital. Of course, they might say the other adjustment also, cash adjustments, etc., etc. But, sir, what if A's asset book value is 10 lakh, but firm is taking over it at 12 lakh rupees? Or you can say A's book value of asset is 10 lakh, A's book value of liability is 4 lakh, so net asset is 6 lakh. So the new firm should give him 6 lakh rupees, right? 6 lakh rupees value. But what if the new firm is giving him 8 lakh rupees, which means new firm is giving him 2 lakh rupees more. 2 lakh rupees more is given by a new firm. What is the reason? Reason is goodwill. If the new firm pays more than net asset, if the purchase consideration, that is the consideration which they give while purchasing the business, is more than the net asset, it will be treated as a goodwill, because firm is getting less but paying more. Why they pay more? To get a advantage of goodwill. That's why it will be treated as a goodwill in the books of the firm. Sir, what if asset is 6 lakh rupees? Net asset is 6 lakh rupees. Firm is paying only 5 lakh rupees. This is nothing but gain to the firm, no? Gain to the firm. 1 lakh rupees is a gain. What kind of gain? Whether it's revenue in nature or capital in nature? It's a capital in nature, because your business is not to acquire each and every business, no. It happens once in long term. Sometimes it won't even happen. So you can say that is a capital profit. So capital profit, where you are going to transfer, sir? Capital profit you are going to transfer to the capital reserve. Okay. So see how the accounting entries takes place. First, sole proprietor closing his books. You are going to transfer the assets, just like you are going to dissolve, that's it. You are going to dissolve his business, that's all. How you used to dissolve? The same thing. There you used to sell it to the outsiders and pay the liabilities. Here usually firm will take the responsibility of paying the liability, as well as firm will take over the assets of your business, existing business. See, realization account debit to the sundry assets, that is assets were transferred to the realization account. Later outside liabilities were transferred to the realization account. So that is liabilities to realization. Later new firm is going to give you certain money, or new firm is going to give you something, might be share in the new firm or something like that. So they will become your debtor for the time being. Until they give it, they will become your debtor. So new firm account debit to realization account. After this you might take and go certain asset. For example, A is having certain rack, okay. In the men's clothing, A had a certain rack. He started with that rack. That was the only rack or a shelf he had when he started the business. So he has that personal connection with that. So A might say, boss, you take and go whatever you want, but please give this shelf to me. Then what happens? That guy is taking and going, no? So the entry will be capital account debit to realization account. Okay. If it is sold to someone else, bank account debit to realization. And if there is any unrecorded assets are there, you have to record it now. Assets to capital. And when you sell that asset, what you will get? Bank, that is bank to asset account. Okay. Payment of liabilities, same as your dissolution. So here the only thing is, difference is, there you used to pay your liabilities and sell your assets. Here together your new firm is taking, that's it. Your new firm is becoming your debtor for the purchase consideration. Later If there is any reserves and all, you have to distribute among them, like if it's a partnership. Later what happens is, those people, the firm, the new firm is our debtor, no? Now they are going to give capital to us. They are going to give capital to us. So what will be the entry? Capital in new firm account debit to new firm account. Capital in new firm account debit to new firm account. But in old business we are already having a capital that we have to close now. Because the whole business we are closing. So that capital account we are closing. How, sir? Debit that capital account, old firm capital account, to capital in new firm. If there is any difference which will be paid through bank to bank account. Okay. In the new firm how it will come? Simple. Whatever the assets is taken over, asset account debit. Whatever the liabilities is taken over, liability account credit. And whatever you have paid excess to your partner, that will be partner's capital account will get credited. If you have gained from the amalgamation, that is your purchase consideration is less than your net assets, then you have to transfer it to capital reserve, no? So the entry will be asset account debit to liability account to partner's capital. Still your asset value is more than this. Although you have paid your liabilities, although you have given so much money to your partner, still your asset value is more than this, then it is transferred to the capital reserve. If it's a goodwill, your asset value is less than what you have paid to the liabilities and what you have given to your partners as a capital. So the difference will be transferred to the goodwill account. That is asset account debit, goodwill account debit to liabilities to partners capital. That's it. That's it in this particular method. Okay. Next one is, when an existing partnership firm absorbs a sole proprietorship. Simple. First, you have to close your sole proprietorship business. Just like which how we done in the first method. Later that sole proprietor will be given a share in the existing firm, which is basically later the admission transaction starts. The process which is there in the admission of partner, no, that process starts. So basically you can say this as closure of the business, that is dissolution of the sole proprietor, plus admission of the new partner into the into the business, existing partnership firm. That's it. See here. The assets and liabilities of the sole proprietor taken over by the existing firm are added to the existing assets and liabilities. So the assets and liabilities will be taken over, no, that will be added along with the existing assets and liabilities. Done, sir. Next, the capital of a new partner is equal to the purchase consideration agreed upon. So you are giving a purchase consideration, no? How you are giving a purchase consideration? You are giving him a share in the new business towards his capital. So your purchase consideration is adjusted towards his capital. Calculation of a treatment for goodwill and capital reserve as the same one. Before amalgamation, all the assets and liabilities of the firm to be revalued. This is how we used to do in the admission, right? We will revalue our assets and liabilities. We are going to share our reserves with to the existing partners. That's it. I mean, first you have to dissolve your sole proprietorship. Later you will start process of admission in the business. Okay. Next is when one firm takes over the other firm. First what happens? One firm which is getting taken over, acquiree. The firm which is getting taken over is acquiree. Acquiree books will get closed. We will prepare a dissolution account of acquiree. Later we will do the admission process in the book of acquirer. The partners in the acquiree were there, no? They will get a future profit share in the acquirer business. They will become a partner in the acquirer business. So what we are going to do, sir? First we are going to dissolve our acquiree business and admission process starts in the acquirer business. That's it. Admission process starts in acquirer business. Next is when two or more partnership forms a new partnership. that is to tackle the competition, big firms, the 2 or more firms coming up with the new firm. Then what happens? Dissolve both the firms, dissolve the firms which are getting closed, dissolve that and start a new firm. Simple. Whatever the assets and liabilities were there in that will come to new firm, and those partner will become a partner in the new firm. So basically you have to dissolve both the firms and form the new firm. That's it. That's all about the amalgamation. It's kind of rapid one, I know, because in revision videos I don't solve the questions, so you might feel bit, it's fast or something, but guys, do one thing, listen to this class, later go to your study material and try to solve the sums. If you are able to solve, revision is of useful, otherwise you can refer the other video. Okay, and also you can get registered to the regular course. You can see the contact number which is coming there, you can contact them. Okay, marketing. Yes, the next unit is conversion of a partnership firm into a company and a sale of partnership firm to a company. That is, let us assume right now we are running a partnership business. Due to many factor, you might have to convert your partnership into a company. For example, government said, boss, what business you are doing? Sir, we are into startup. What kind of entity you are? We are a partnership. Government says no benefit. No benefit, boss, no benefit. I am just giving an example. Government says if you are a LLP or a company, then you can get a benefit of a startup. If you are a LLP or if you are a company, then you can get a benefit of the startup, whatever the benefit we are going to give it to the startups. If you are a partnership or a sole proprietor, sorry sir, no benefit. No benefit. That might one reason where you are going to convert your partnership into a company. Or right now you are having a 50 number of partners, you want to add one more, whereas in partnership it's not available. In partnership you can't have more than 50 partners, of course, as per Companies Act. So you are going to convert partnership into a company, private company. So there might be different things. Also, the wife of partners, the wife is there, no? Let us assume there are partner A and B. Wife of A is there, no? Mrs. A. Her friend is, let us assume there is one more guy C, Mr. C, who is a MD of the company. His wife is Mrs. C. Now these two are friends. So one function they met. She asked what your husband is doing. She was like, okay, he is running some partnership. She asked what your husband is doing. She was like, my husband is a MD in the company. So ego hurt. So that might, later she came to A and told, boss, you are stopping partnership and you are also starting a company. That might be one reason. So there are various reasons, not that this, various reasons. So you might convert your partnership into a company. What you are going to do, boss? Simple. Dissolve your partnership, start a company. Dissolve a partnership, start a company. Earlier also we did the same thing, no sir, in amalgamation. No, there you used to get what? Share, profit sharing ratio, profits, share of profits. Here you are going to get a shares, debentures, either it might be in a cash also, you never know. Company might pay you certain shares, company might give you certain debentures, etc, etc. Okay, so in consideration, you are not getting anything like profit sharing. At the end of the day, both are same. Private company and partnership almost it's same only sometimes. But even shareholders will get a share in profit, no? If they earn a profit, yes. So you can say that way. So only difference is that, boss. There you are going to get a share of the capital. Here you are going to get a shares of the company or debentures of the company, depending upon your agreements. See, you are going to pass the following entries in the selling firm. That is, when you are going to transfer your assets into the realization, entry will be realization to the sundry assets. Later you are going to transfer your liabilities to the realization. So the entry will be liabilities account debit to the realization. Later you are going to get certain purchase consideration for your net asset. So the entry will be the company will become your debtor now. So the purchasing company account debit to realization. Later you might take over certain asset, the entry will be capital to the realization. Later you might pay certain assets which is not taken over by the company, that you might be selling on your own, the entry will be bank to the realization. There might be certain unrecorded asset, the entry will be asset to capital, and when you sell that asset, bank to asset. So you might pay the certain liabilities on your own which is not taken over by the company, that is realization to bank. And you might get one unrecorded liability, the entry will be capital to liabilities, because you have to create a liability now and now write off the liability, that is pay the liability, so the entry will be liability to bank. And if you take over the liability, that is as a partner, if you take over the liability, entry will be realization to capital. So many things are there. Later you are going to get shares in the purchasing company, debentures in the purchasing company, or cash, anything, or together with all these three together. So the entry will be shares in the purchasing company, debentures in the purchasing company, cash in the purchasing company account debit to purchasing company account. In the purchasing company, same as partnership, new partnership we form now, that is asset will be added to your assets, liabilities will be added to your liabilities, and the capital you are giving, right? So it might be end up in goodwill or a capital reserve. For that also you are going to give a treatment. That is, if it's a goodwill, asset value will be less, so goodwill debited. So asset account debit, goodwill account debit to liability to firm account. That is purchase consideration. You can pass it as firm account, or you can directly say it as share capital, debentures, bank, etc., etc. When your asset value is less than your net asset value is less than your purchase consideration, it is called as, when your net asset is more than your purchase consideration, it will be called as net asset is more than purchase consideration, capital reserve, right? So the entry will be asset account debit, two liabilities you have taken over, two purchase consideration which you have given, still something is pending, that you have to credit to capital reserve account. That's it. That's all about amalgamation of the firm. So we'll meet you in the next video. Until then, bye bye. Please subscribe to the channel.